Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, markets are continuing that sort of sideways churn, and we're pushing up to levels of resistance and then falling back to levels of support. So if we take the US stock market, so the S&P 500, for example, we rallied up towards the 3,000 level again this week. And that was largely because of positive news surrounding lockdown measures being eased globally and even in America. So that was met with some optimism. So the market started to rally. To reflect that, markets elsewhere around the globe also started to rally. So we saw the FTSE 100 head back towards that 6,000 level and give it a nice high five. But as this week has gone on, we've now started to see the markets pull back slightly. So during the period when the market was rallying, we saw the VIX fall to some of the lowest levels we've seen in weeks. The VIX, the VIX, the fear gauge got down to around about 27. There would have been people who were watching that would have started to get that fear of missing out, that FOMO feeling, and were thinking that the market is about to explode higher. I mean, that hasn't been ruled out yet, but the market's got a lot of work to do if we are going to see that. Principally in the US, you want to see the S&P 500 move strongly above the 3,000 level, which happens to be the 200-day moving average, close above there and then be able to push on. We want to see breadth improve. We want to see other stocks, not just the technology stocks, do well. So we want to see financials, other sectors start to join in. Those sectors like financials have been lagging. And in a strong bull market, you want to see a breadth in that rally. So we had the market push higher again this week, but it started to pull back. And ominously, there was a technical sign that showed something quite bearish. And that happened around about Tuesday this week, where the market took a turn for the worse. And some of that came about because obviously Donald Trump is still trying to have a go at China, accusing it of creating the virus. There were suggestions of a China-US trade war erupting again. But we also had some comments from the US Federal Reserve this week that suggested that there wouldn't be negative interest rates. And if you know this market, equity markets, they love monetary policy. They love loose monetary policy. They love quantitative easing, so money printing. They like low interest rates. So for the equity market, that was a negative announcement. So they took it slightly negatively. So the market pulled back ever so slightly. But where we are now, the S&P 500 is starting to test that crucial 2,800 level. And if we start to pull back and close below that, then we could see the market unravel slightly. And we've seen the market pull back 1 to 2% for the last couple of days, and it's been replicated in the UK. We high-fived that 6,000 level when we started to pull back. Now we're heading back sort of towards 5,800. And the VIX, the VIX, has leapt back above 30, started to head towards 40. So it's now around about 36, 37. You're seeing bond yields start to plummet, which means bond prices are rising. We're seeing gold start to attract money. So havens are starting to do well. So if havens continue to do well and we see that continued weakness in equity markets, that may finally confirm that we've had a bear market bounce, a bear market rally, and the market might turn lower. There's a lot to still happen in the coming days. But why has the market turned lower? One of the reasons is the Fed, of course. The other is we had another billionaire investor. It's David Tepper, who came out and said that he felt the market was the most overvalued since the dot-com bubble. So like Warren Buffett last week, if you have a billionaire investor start to question the value in the market and sits back and perhaps holds more cash than he would normally do, then that starts to undermine investors' confidence. Usually these billionaire investors have had such a great record by buying when other people are fearful. So does that suggest that they think the market is still overvalued and that people aren't fearful enough yet for them to enter the market? So things could get a hell of a lot worse. So other investors are starting to take note and perhaps being a bit cautious. Now, the other announcement we had from the US Federal Reserve was that there probably wouldn't be a V-shaped economic recovery. Now, there are parts of the market that have been betting on there being a V-shaped recovery, but you could also argue, if you look in other places, the fact that things like Netflix are rallying while financials are struggling and haven't rebounded to the same degrees, perhaps a reflection that people think the current status quo is going to continue, i.e. we are all going to be home watching Netflix more and the economy isn't going to rebound as quickly as people are thinking. Either way, that dealt another blow to investor confidence. And on top of that, in places like China, in Wuhan, and of course in South Korea, where we've had easing measures in relation to the coronavirus, they're started to see an uptick in COVID-19 cases. So that has started to put the idea that we could have a second spike globally in the coronavirus pandemic. That would have a massive impact on the global economy. So that started to dent optimism. So the message is keep an eye on markets in the next couple of days, see if they continue to break down or whether that almost uniquely American fear of missing out starts to push the market higher again and back towards that 3,000 level. As I've mentioned in a couple of previous episodes, the FOMO that we're seeing in America seems to be solely focused in America. If you look at European equities, if you look at UK equities, we haven't seen the rebounds that we've seen in America. So it'll be interesting to keep an eye on that relationship going forward as well. So a lot of the short-term action in equity markets is being led by the headlines surrounding the coronavirus. But of course, as long-term investors, we shouldn't get bogged down in the sort of nuances of the daily moves of stock markets or news headlines. And we should instead focus on the longer term and try and control our emotions so we don't make bad investment decisions. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me. Damien at moneytothemasses.com is the email address. Money to the Masses with the number 2 is the Twitter account. And of course, you can catch us on Instagram, YouTube and Facebook. Don't forget to join our Facebook group, facebook.com/groups/money to the masses.